Ed Parks, Jeff Rowe,
Here.
and Ed is absent today.
Thank you. Old business, Hound Resources, royalties, see attached report. Do we need to go over that, or?
No, it's just for your information. Ed would typically give you an update.
Okay.
Well, it looks like we picked up
Yes,
some money.
that's the change, is that they've finally started to send the royalty checks.
I like the 74,000.
Yeah.
We don't need to do anything on that, right? Okay, so new business approval of minutes from January 25th.
So moved.
Support.
All in favor?
Aye.
Aye.
Aye. Motion passed.
Investment advisor, update and commentary.
Hi, Woody. We're ready to go through the report when you are. Thank you. Woody?
Yeah, hold on just 1 minute.
Okay.
And, we're good. Well, good morning, Manistee.
Good morning.
Hey,
So we'll start with page 4, which is the kind of the economic overview, and we have a number of points here. A lot of this has not changed from our last meeting, which is inflation continues to be the primary, uncertain factor that drives the markets today, and there's probably, it continues to be probably the same uncertainty level in terms of whether it's subsiding, stabilizing, and just where that stands. We've had encouraging news, as we'll show in a moment with another chart, that it has continued to drift down over the last few months. And, it's still globally more of an issue. Europe still sees more inflation. And there's just, it's a really big factor with the markets because how hard the Federal Reserve will have to slow down the economy to get inflation under control will determine whether we have kind of a hard landing or a soft landing. In other words, a recession or maybe just an economic slowdown. So that's kind of a big deal. You can see some of these other positives and negatives on page 4. Certainly, stocks are more reasonably valued since they've come down over the last almost 2 years. Stocks have been kind of flattish and certainly down over the last 18 months. So stocks are more reasonably valued. For the first time, we have bonds more, with yields that are more competitive than what we've seen really in quite a number of years. So, in a lot of ways, we've had a return to normalcy with stocks and bonds. Stocks reasonably priced, bonds with good yields of 4 to 5%, and then still an economy that's reasonably good. Unemployment's very low. Household balance sheets are in good shape because consumers didn't spend as much during the pandemic, and a lot of them got government stimulus payments. Those are still in the bank. So a lot of pretty encouraging news. Obviously, a lot of uncertainty and potential disruption globally and domestically. But overall, we're encouraged around those types of factors. And I'll let Troy, if he wants to maybe fill in with kind of his overview or color of that.
Thanks, Woody. Good morning, everyone. As Woody said, the big thing is the inflation rate and the progress that the Fed's making there. Pretty optimistic on some parts of the inflation improvement. Energy costs have been coming down, as probably a lot of you know. Some of the sectors are kind of sticky, and the one measure of inflation that the Fed pays a lot of attention to is the core inflation rate, which factors out food and energy. And that's been more sticky and kind of has been hanging around, upper 4%, 5% range. And so the Fed's going to continue to look at that pretty closely as they decide when they're going to pivot and and go into maybe a long-term pause even at these interest rates that they've just hit now with that last hike that they did last week. So from the bond market's perspective, there's a lot of expectations here that the economy is going to slow eventually. Because of that, longer-term interest rates have come down in anticipation of a slower economy eventually. And so we've got an unusual situation where short-term interest rates are a lot higher than long-term interest rates, which bang for your buck, if you're just going to buy one bond, you could buy a one-year CD and get close to 5%. Meanwhile, 10-year Treasury note yields are out, just a little bit less than 3.50. So, it's an unusual time in the bond market. The other thing that's been kind of creeping in lately is credit spreads, which is the extra amount of yield that a corporate bond issuer needs to pay over a Treasury note. Those spreads have moved down a little bit. Not alarming, but they've moved down a little bit. The one sector, and this won't surprise you, the banking sector has had the most disruption in credit spreads. Those have moved out notably, and so we're keeping an eye on that sector. Of course, we all know that some of the problems with the banking sector is that, the risk that deposits can move and leave a bank vulnerable to their other liabilities. So that's a relatively new development, but not really surprising since the interest rates have gone up so much over just a short period of time. So a lot of banks are wrestling with that challenge, and I think it's not a problem for the bigger banks. I think some of the smaller banks that don't have such a diversified portfolio may be more at risk in these type of things. But we don't have a lot of bank exposure in the portfolio. I think I noted one bond on the bond side. And so just, throw that out there. I think we're in a pretty good position here. We'll get to the bond portfolio in a minute. It's still very high grade. I think we're positioned very well if we do get a recession. And, I think we'll come through that, fine. If not, even have an opportunity to, opportunistically add some good names if they cheapen up.
So we'll hit on a couple pages here. The following page is inflation's been disruptive, and you can see over the last 2 or 3 years how inflation peaked at 9.1% last June and has been in a declining mode, currently around 5. Last month it was actually 4.9, so that's encouraging and important to see that continue to dwindle. Let's see. Next page, I'll let Troy talk about that briefly.
Yeah. We put this page in to kind of highlight how unique this hike cycle, if you want to call it that the Fed began last March of 22, is compared to other periods where the Fed was tightening monetary policy. And this cycle, we've gone up now 10 hikes, over 5%. This chart's, I'm not sure what this was, it's a little dated, so we got to update this chart. But, very unique there, how steep that first curve is for this cycle, how far interest rates moved and how fast they moved. By contrast, you can look down there at 2015, that period of time stretched over almost 3 years, and the Fed gradually raised interest rates during that time, and didn't go as far. So very unique period this time. I think you can argue it's because the Fed kind of waited too long maybe to get started, and there was also record stimulus that was put into the economy during the pandemic. So those two factors, I think, have led to this response from the Fed.
The next page points out the probability of recession as indicated by the leading economic indicators index. And you can see those gray vertical bars. This is going back almost 60 years. You can see like 1970, 75, 1980. Those gray bars are recessions. And you can see that the index typically will begin to turn turn down usually 6 to 12 months before the recession occurs. And it's been pretty reliable. There's been a few false starts or false indicators, but generally it's been pretty reliable. And when it's turning down now, that is giving a pretty good flash or forecast that, we might have a recession. That's something to follow, this leading economic indicators index. The next page just points out that stocks are reasonably valued going back to 1956. In other words, these price earnings multiples, we're right about the median right now. And this is really most valuable when it's at extremes. In other words, when it's the line is either above or below the dashed line. It's probably when it's meaningful, maybe not so much when it's in between there. But at extremes, when the market is either very overvalued or undervalued, it has meaning. And then the last page is, you've seen this one too. We've used this quite a bit. It just shows the history of market volatility. I don't know that we need to dwell on that. I think maybe now is a good time to maybe take a pause and see if there's any comments or questions.
I don't have anything.
Do you see any more rate increases coming in the future, especially going closer to the election in 2024?
I had a hard time hearing that. Could you say that?
I'll repeat it.
I'm sorry.
I can repeat it. Their Councilwoman Linda Beaton asked if we see any more rate increases leading up to the election
2024.
to 2024.
I'll just jump in. I think the Fed is in a good place to pause if they get a sense that inflation is starting to roll over a little better maybe than it has shown lately. So I think these next economic measures that come out monthly over the summer will be very important to give the Fed the confidence they need to sort of stand by and pause. And I think, I'm going to guess they'd like to have their work done before we hit 2024. They'd probably like to be, in a stable position, if not, maybe even, if they're lowering interest rates, that means the economy is slowing. So I'm not sure they want to see a slowing economy either. But, that's the fine balance that they face is, what do they do going into an election year? I guess I don't know that they would say that that's important to them. I think it probably is. I think we all know it probably is. But I think if they were asked that question, I think they would probably say they're more tuned into what inflation's doing and what, the employment situation looks like.
There's typically a lag effect when the Federal Reserve starts to raise interest rates.
Hold on one second.
I'm sorry. Historically, going into an election the year before, interest rates have not risen, so that's why I'm asking the question.
Could you repeat that?
She said historically interest rates have not gone up on election year, so that's why. But I think you mentioned you thought they'd want to have it done before 2024. So they're not going to probably mention what they're just going to look at the data. Is your comment?
Well, I think they've pretty much established that getting inflation under control is mandatory. I mean, it's a very high priority, and any changes in any further increases in interest rates will be dictated by what the monthly inflation trend is and just how firm the economy is. And if inflation stabilizes here at 5% or edges up and the economy is still pretty strong, I would guess that there's a very strong case that they're going to raise interest rates more. But there's also that kind of lag effect, which is when they start to do this, it takes a while to work its way through the economy, and so they might want to just wait and see what happens. But I think our feeling is generally, Linda, that it's going to be month to month based on how firm the economy is and what those inflation numbers are showing. And if the economy stays reasonably healthy and inflation stabilizes or goes up, you're going to see more rate increases, irrespective of the election cycle. Because if this gets out of more control, no one's going to get elected if you've got inflation still running pretty strong.
Thank you.
So, any follow on to that?
I have a quick question for you guys. When you think about inflation and economic forecasting at Bartlett, do you all look at M2, our money supply? Because that's had one of the steepest declines going back in, a long, long, long time.
Yeah, I do look at that M2 measure, and I agree with you. It's fallen off a cliff as the government has tried to rein back in all that excess stimulus that was put in the market. So it's a factor. I mean, it's another variable that you look at to tell you that the economy could be moving into a period of slower growth because there's less fuel in the economy, essentially, as they pull back on money supply. And so that said, when you look at the absolute level of M2, it's still pretty darn high. So there's it's kind of like they're pouring less gasoline on the fire. There's less of it, but there's still some out there.
Yeah, and it's interesting. I was reading an article overnight that talked about the fact that the lending facility that they set up for the banks actually is acting as a quantitative easing because essentially they're pumping money back in at, par value versus the discounts. So.
Yeah, they're basically offsetting some of the good work they've done so far at removing some of the M2.
Yeah.
Yeah.
Thank you.
Yeah, good point.
Well, let's go into the Manistee oil and gas portfolio. On page 11, we can see an overview of the asset allocation. You can see as of the end of April, we were just about $12.5 million, and we're on the far right are the target assets or the target allocations. So the investment policy indicates 5% in cash equivalents, money market funds, and 30% in fixed income, and 65% in common stocks. And we're slightly overweight on common stocks. That's because coming out of starting the year, the stock market's been pretty strong. So I think we were around 65, and that's gone up, a little bit. But generally, we're pretty close to the targets. We're a little underweight on international equities relative to the target. That target's not on here, but we, in the policy statement, if you look on the performance page, and the footnote will show that we typically would target about 10%. And that's an area that we will expect to increase that in the near future. But again, we're going to try and keep these equities around the 65. Right now we're 66.4, but we're going to try and maybe nudge that down a little bit.
Page 12 is a look at the bond portfolio, part of the overall asset allocation. As Woody mentioned, is to bonds, and they provide sort of the stabilizer to the portfolio. In this case, we were managing to an intermediate goal here. You can see the average maturity in that table is a little over 4 years. The duration, which is a bond interest rate sensitivity measure, bond talk, or an intermediate portfolio about 3.6 to 3.8 years, and the yield 4.3, up materially over the last year, which is thanking the Federal Reserve for raising rates has helped that. And then the average credit quality is still very good at AA minus. So again, we have a good. If you look at the charts, you'll see there the portfolio is in the green, and we're pretty well spread out over the 1 to 10 year maturities with an emphasis on 1 to 5 year really. We've got a lot of bonds coming up in the next year, so we'll be able to reinvest those pretty soon at some higher interest rates, and that'll help the portfolio over the long haul. In the lower left quadrant there, you'll see that we have a pretty good emphasis on corporate bonds and treasury bonds, and we do have some mortgages and agencies in the portfolio. And then lower right there, you see the credit quality. Again, a strong emphasis on A or better credits. We do have some triple Bs in there. No junk bonds. That would be under the not rated there, and there's none of those. And so again, the portfolio is meant to be, a stabilizer for the portfolio, and it's established there to provide reliable income to complement what's going on with the equities. Any questions on the bonds?
No questions.
Okay.
Next page is how your stocks are diversified within these 11 Standard & Poor's industry sectors, starting with information technology at the top and going down to real estate at the bottom. We have these ranked by size, and you can see over the last several decades, information technology has really just ballooned into 25.8% of the market index, and then followed by healthcare, financial stocks, consumer discretionary. And you can see we're generally allocated in a healthy way relative to the index. We're currently a bit underweight on information technology, and that's kind of partly due to a technical factor. A couple of the stocks that we owned, Standard & Poor's moved out of, the biggest one was MasterCard, moved out of information technology, and they moved them into the financial sector. So that's one of the main reasons we're overweight a bit on the financials, is because a stock that had been in a different sector was moved into that. But generally, we're very, very diversified. And the next page, this is one that we've looked at from time to time. It's kind of interesting. It just shows the history of the fund. And with the oil and gas royalties, the distributions for the capital budget, and then that spending rate, which is based on that percent of the trailing 12 quarters. What's kind of interesting is if you look at the original value of the fund back in 2008, 6.7 million. You look on the next page, so far total distributions have been about 6.4 million. So here, probably in the next several months, when the next capital budget disbursement is made, you'll see that the total distributions exceed the original value of the fund, which is almost double the original value, even though we've taken out all the money that was initially there. So that's kind of fun. Next page is the performance, and these numbers somewhat speak for themselves. You can see year to date, strong market so far this year, and then these trailing periods going back to 09, and they don't have too much to add here. Happy with the results, and turn it over to any questions.
Guys, I do have a quick question on the cash and cash equivalents. On page 11, it says there's a little over 680,000. What's that actually sitting in right now? And do you guys have an estimated yield on what we're sitting in?
I don't know, did you hear that, Woody?
Can you repeat that, please?
They're wondering where the cash equivalent is at in just a market fund. Is it getting any interest sitting in or is it just stagnant?
It's in a Schwab government money market fund, and the yield on that, I think is in the mid fours, but I'm not sure.
The mid,
Something a little over 4. It's a good question because prior to a couple months ago, we were in a different money market fund. And with the crisis within the banking sector, we shifted that to this government money market fund. Very slightly less yield, but no issues with credit because they're all government issued money market instruments. So no risk of default there. But it's getting the money markets, I think, getting around 4%.
you found it,
Yield.
Doug? It was in
Yeah, it's on page 18.
18.
Yeah.
Thank you. Oh, yep.
This is the newer breakdown.
Any other questions? All right. Well, I think no other questions at this time. Thanks, Woody. And yeah, it's exciting to see that, yeah, what we've dispersed is reaching the principal amount that started. So,
Yeah.
all right.
Okay, so meeting date changed from Friday, July 21st to Friday, August 18th, 2023. Does anybody else have anything else? Motion to adjourn?
Could we just have a motion to change that date?
Oh,
If
okay,
that's,
sorry.
okay.
Thanks, Woody. Thanks, Troy. Take care.
Okay.
Thank you, Bill. Thanks, everyone.
Sorry, I didn't hear it.
Thanks, guys.
Bye-bye.
Bye.
Sorry, just.
I'll support.
Okay. All in favor?
Aye.
Aye.
Okay, motion passed.
Okay, anybody else have anything? Motion to adjourn?
Okay.
What's more interesting is that as the 08, the 6 million, when they took it over, the fund's been around since the early 80s, late 70s.
Oh, okay.
And,
Does it really date back that far?
yeah.
I didn't know that.
Well, we used to get lunch.
The auditors don't like that.
But the silly thing was, under the then way it was set up, all you could invest in were CDs.